Whilst most traders were having emotional breakdowns during last week's market crash, my students and I were executing on our most profitable trades of the year. Now, what's the difference? It's not our chart patterns, it's not our indicators, it's not even our capital. It's our psychological approach to market volatility. In my years of day trading, I've discovered something that changed everything. Your trading psychology determines your profitability more than any strategy ever will. Today, I'm going to reveal the mental framework that allowed us to stay calm, focused, and profitable during a market event which wiped out trillions in trader capital. Now, this isn't theory. These are battle-tested mental modules I've developed that turn market chaos into opportunity while everyone else is panicking. Now, before I break down these mental modules, let me be completely transparent about something. Trading psychology isn't some abstract concept. It's the single most important skill you can develop as a trader. Every trading strategy works until it doesn't. Markets change, patterns fail, but the traders who consistently profit have mastered something far more valuable than any technical indicator. We've mastered our own mind. When Trump announced those tariffs and the markets plummeted, I watched two types of traders respond. The first group froze in fear. They sold at the bottom, they locked in devastating losses, all because they allowed their emotions to hijack their decision-making process. The second group, a much smaller percentage, recognized the volatility as a profit opportunity. They didn't just survive, they thrived because of it. The difference wasn't luck or timing, it was psychological preparation. What I'm about to share isn't general psychology or mindset hacks. These are practical tools you can implement immediately to transform how you respond to market volatility. Let's break down the 5 critical mental modules that separates profitable traders from the masses during market turbulence. Mental module number 1, the volatility reframe. Most traders have a fundamental misunderstanding of what volatility actually is. They see it as a risk, a danger, or something to be feared. Professional traders understand a critical truth. Volatility is the only reason we make money. Without price movement, there is no profit opportunity. The bigger the potential move in the market, the bigger the profit available for us. Market crashes create the largest and the fastest price movements possible, which also means they create the largest and fastest profit opportunities. Now, here's how you implement this reframe. When you see a market sell-off beginning, train yourself to immediately ask, where is the opportunity in this volatility? Instead of, how do I avoid losses? Start thinking about, how do I position myself for profit? This isn't positive thinking, this is strategic thinking. It's recognizing that volatility is essential in making profits. Now, I've developed a volatility opportunity checklist that I run through whenever the markets have become turbulent. Now, the first question is, which sectors are being unjustifiably dragged down with the broader markets? The second question is, which assets are showing strength during the sell-off? The third thing I ask is, which higher time frame key levels would create my point of interest to position? The last question is, which pairs are showing divergence between price and momentum? By focusing on opportunity-seeking questions rather than fear-based emotions, you automatically shift your mindset from defense to offense. The second mental module is emotional decoupling. The biggest psychological mistake that traders make is attaching their identity and self-worth to the outcome of individual trades. When a trade goes against them, they take it personally. They feel like they're a failure. The emotional entanglement leads to revenge trading, hesitation, and poor decision-making. Now, here's how to implement emotional decoupling. The first thing is to recognize that the market is never personally attacking you. It doesn't even know you exist. It doesn't care about your positions. It is simply an auction mechanism responding to supply and demand. Secondly, separate your identity from your P&L. You are not your trading account. A losing trade doesn't make you a loser, and a winning trade doesn't make you a winner. They're simply feedback mechanisms telling you about the current market condition. Now, I teach my students a specific practice called the 3-2-1 reset that helps decouple emotions from trading decisions. Take 3 deep breaths, make 2 market observations, and ask yourself 1 strategic question. Now, this simple pattern interrupt can prevent emotional contagion from one trade to the next. A critical skill during volatile market conditions where you need to make rapid decisions. Mental module number 3 is strategic expectation management. Most traders have completely unrealistic expectations in what constitutes success in volatile markets. They expect to catch the bottom, avoid all losses, maintain the same win rate that they had in calm markets, and execute their strategy with perfect precision under pressure. Now, these expectations are psychological traps which guarantee frustration and poor performance. Traders use a concept I call strategic expectation management to maintain peak performance during market turbulence. Here's how it works. The first thing to do is explicitly adjust your performance metrics for volatility. During normal market conditions, my expected win rate is about 65%. But during volatile market conditions like we seen last week, I adjust it down to 60 to 55% accordingly. This isn't lowering standard, it's recognizing reality and setting achievable targets so that psychological pressure does not start to build up. This isn't lowering standards, this is recognizing reality by setting achievable targets that prevent psychological pressure from building up. Secondly, focus on your process metrics rather than your outcome metrics. Track perfect execution rather than just your P&L. During market crashes, your execution quality matters way more than short-term results. Thirdly, implement the 2 time frame rule. This provides psychological context that prevents overreaction to short-term results. Mental module number 4 is the uncertainty advantage. Market crashes create uncertainty. Most traders see this as a negative, but that is something you want to avoid. Uncertainty is actually your greatest advantage as an individual trader. Large institutions and algorithms struggle with uncertainty because they are built on historical models and patterns. When the markets enter uncertain conditions, those advantages disappear. This creates a rare window where individual traders can actually have the edge over institutions if they have the right psychological approach. Here's how to implement the uncertainty advantage. Firstly, recognize that periods of maximum uncertainty create massive mispricing in the markets. Assets get oversold based on fear rather than the fundamentals. Now, this creates asymmetric risk to reward opportunities that do not exist in normal market conditions. Secondly, look for discount opportunities where the market is priced into that you have to act on regardless of what you perceive is happening. What is being said in the news is there to put you off so you make no decisions out of fear. This is the opportunity to actually do something. Third thing, use the scenario planning technique. Rather than trying to predict exactly what will happen, which is damn near impossible, map out 3-4 scenarios with probabilities and planned responses if areas are met. This approach allows you to act decisively amid uncertainty, whilst others are paralyzed by the need for certainty before acting. Mental module number 5, contextual risk management. The final and perhaps what I think is the most important module is what I call contextual risk management. Most traders use the same risk parameters regardless of market conditions. They risk the same percentage per trade during calm markets and volatile markets alike. Now, this is a critical psychological error. Professional traders adjust their risk parameter based on market context. This allows them to stay in the game during volatile conditions without blowing up their accounts. Here's how I implement contextual risk management. During normal markets, I risk 1 to 2% of my account per trade. During extreme volatile conditions, like after we saw the tariff announcements, I automatically reduce my risk to 0.5 to 1% per trade. However, this is the counterintuitive part. I increase the amount of setups that I take. This creates optionality while limiting the impact of any single trade going wrong. I also implement the volatility position sizing formula. As the average true range increases, my position size decreases proportionally. This ensures that my risk stays consistent whilst the price movement becomes more extreme. This approach allows you to stay active during market crashes without the psychological burden of oversized positions, which can lead to emotional decision making. Now, here's the ultimate truth about trading psychology during market chaos. The traders who profit during market crashes aren't just lucky. They've developed a specific mental operating system that transforms volatility from a threat into an opportunity. You don't just survive market crashes, you thrive because of them. This isn't about being fearless, this is about transforming fear into strategic action. It's about having a psychological framework that allows you to see opportunity that others miss because they are blinded by emotion. The traders that emerged with bigger accounts from last week's crash didn't just have better strategies, they had better minds equipped for trading. That is something you can develop regardless of your experience level or account size. If you're ready to develop the psychological edge which turns market chaos into profit opportunity, click the link in my bio and watch my free training where I break down my best trades over the past quarter. Using the link in the description below, you'll opt in using your email address to get access to my newsletter and also access to my Telegram channel, which is free for now. In this blueprint, I share psychological exercises I use before, during and after trading sessions to maintain peak performance regardless of market conditions. Drop a comment on which module resonated with you the most. and I'll expand on that approach in my next video. Remember, in trading, your mind is the most valuable asset. Develop it with the same dedication as you do your technical analysis, and you'll be able to withstand any market crash. Peace. Thank you for watching the latest episode. If you like that, please like and subscribe to my YouTube channel for more content. I'll see you on the next video.